What I thought I'd do is I'm going to give you this kind of little bit of history. We're going to start back when I started, 1980. We're going to kind of go through where we've been, what happened along the way, what caused the markets to change, events that really impacted where we are today, in fact, and why we're there, and what that means, implications for investors, implications for organizations like yours as you look to manage money, as you look to oversee the asset managers who are managing your money. And then at any point along the way, raise your hand. I'm happy to go over it and talk about it. This is by no means right down to the wire like this. And at the end, I will talk about my own 9/11 story, which after this was, I can't even tell you. Okay, so here we go. Now, I like to call it the golden age versus the electronic age, right? Because the golden age is what was. It was what the industry was, what the market was, what the U.S. capital markets were when I came into this business in 1980, and really what they had been for 225 years until a number of events happened, really starting towards the end of the 90s as we moved into 2000. 9/11 played a significant role in kind of the current market structure today, and then we'll see that as we go on. So we go from, and you see that big canyon in the middle, what I call the golden age, into this electronic age. I've managed to, navigate my way through both. I will, if you ask me, I will tell you I certainly like the golden age, but I think most of us probably would prefer the days of yesteryear, right? So here we go. We're going to start in 1980. Now, if many of you remember, 1980, Jimmy Carter had just lost the presidency to Ronald Reagan. The Iranian hostage crisis, interest rates were 13%, unemployment was 10.5%. It was a semi-mirror image of what's happening today, other than rates, right? Rates are so low today. Then rates were much higher. Here's we were. This is going to be a chart, as you'll see, of the Dow Jones Industrials as we kind of progress through the 30 years. And I'll just make points along the way that I think are significant. We can go back over to this or stop me along the way with any questions. So here we go, right? The summer of 1980, I was down there as an intern. Summer of 80, 81, and 82, I was down there as an intern. In 1982, if you remember, Ronald Reagan was instituting new economic policies, very much the same debates going on today. Tax rates, raising them, lowering them, trying to get the economy back again. It was August 12th, 1982, and I was going into my senior year of college, but I was down on the floors working for this independent broker, when on this Thursday morning, and I believe it was August 12th, the FOMC, then headed by Paul Volcker, was making their announcement about rates, what to do with rates. And rates were 20% at the time, if you remember. And so people could actually take their money and put it in a bank CD and go to sleep at night and earn 20% risk-free. They didn't worry. They didn't, is the stock market going to go up or down? What's Apple going to report? They could put their money away and sleep every night. And so, in fact, that's what people did. Why would you risk when you could get 20% on your money? And so, therefore, the Dow Jones Industrials were trading it in the high 700s, like 790, 800. Today it trades at 12,000, but so just to put it in perspective, right? But on this day, Paul Volcker came out at 8:30 in the morning and made the announcement that the Fed was cutting rates by 2 percentage points. 2 percentage points was a massive move. So they were going from 21% to 19%. Now, even though they were still high at 19%, the signal that it sent to the markets was just incredible, that rates were going to come down, the economy was getting better. Volcker made this statement, and so the market just exploded on this day. And if you remember, it was August 12, 1982, and we used to trade on the floor maybe 35 million shares a day, all by hand, all by paper. And, the market would move up 2 points, down 3 points, up 4 points, whatever it was. On this particular day, the market ran 4.5%. It was up 35 points on 138 million shares. So this was from Wednesday to Thursday. All of a sudden, the place exploded, right? Because it sent the message that the economy was turning around. It was actually a very good message, right? It was a good message for Americans to understand. So here's where we were. This is kind of like the beginning of my experience, right? But now remember, I'm going back to college in September of 1982 to finish my senior year. Actually, and I really debated it because it was so exciting down on the floor. I almost thought maybe I'd just stay and finish school at night in New York because I went to BU. And then I decided, I had already spent $30,000 up to this point going to college, and I had one more year, and if I didn't finish, I was never going to finish. And you know, and I laugh when I say I spent $30,000 going to BU. I just put my daughter through Vanderbilt at $250,000, and so it's just unbelievable to me, right? But okay, so the market takes us to, from 1982 to 1987, we just went on this bull run, right? It was an exciting place to be. You would remember maybe, you know, you see the images on TV. There were 5,500 Type A personalities in one room, all vying for buying and selling stock on behalf of customers. Now, customers were, and still are, customers are the broker-dealers, so they could be the investment banks, the regional broker-dealers, you know, the Goldman Sachs, the First Bostons, the Morgan Stanleys of the world. Customers are also hedge funds, mutual funds, pension plans, and the customers of the customers are us, right? You, me, individually as an organization. So when you take your money in your 401k and it's invested in a mutual fund, so you are really a customer. Although you're not my customer, because my customer is the institution, right? You're the customer of the institution is customer of mine. So when that institution decides they want to buy and sell equities, they're going to come to me to help them do it. Now they're going to come to me, they're going to come to other brokers to help them do it, right? And so that's my role. And I was always right downstairs on the floor of the New York Stock Exchange, and I was always right in the thick of it, and it was the most exciting place to be in the world. If you can imagine every day getting up, you know, and running into these 5,500 Type A personalities from 9 o'clock in the morning till 4:30 in the afternoon, it's like having a gun to your head all day long. It was the most exhilarating experience that you could have, right? So here we go. Okay, so now we're into, I know that sounds nuts, but it is. But, okay, so this takes us to 1987. And so it's funny because I got married in 85, and my wife, which is very important, was also a member of the New York Stock Exchange. That's where we met. We met on the floor of the exchange. She had worked there started as a runner and then became a clerk. And what's interesting is that she became a member in April of 1984. Now you have to understand there were 1,366 members. 5 of them were women. The 1,361 were men. It was very much, as you probably hear people say, it was like the boys' club. It was a private institution. The seats represented the stock in the organization, but it was private. And when my wife had the opportunity to become a member in 1984, it was a big deal. It was a big deal because A, she was a woman, B, she was a minority, and C, she had worked her way up. It wasn't like, you know, daddy was in front of her or her uncle was in front of her or somebody gave her the seat. She had done it all on her own. So we got married in 85. She had one business, I had another business. She got pregnant. She ran around till she was 7 months pregnant, doing her thing, and then she stopped in January of '87. We bought this house. Life was perfect, right? We were just going along. It was everything it was supposed to be. I was 26 years old. I had a great job. I had a house with a white picket fence. I mean, I had a kid coming, and everything was perfect, right? And then the crash. And so what happened was, you know, as we moved through the summer of 1987, you could start to feel some global turmoil. But understand what was very interesting then versus now is that the global turmoil in the news did not travel at the speed of light the way it travels today. I mean, today, something happens on the other side of the world, and you know about it on Twitter in 5 seconds. You know, Angela Merkel stands up and walks out the door, and everyone's tweeting about it. Well, what does it mean? I don't know what it means. She walked out of the room. What does it mean? But yet, people use information like that all day today, and I'll show you how that happens as we move along. But then, the world didn't move like that. And if you remember, it would take a day and a half to find out what was going on in Asia, because don't forget, they're ahead of us, right? So on Sunday night at 9 o'clock our time, Asia opens. Asia trades all day, then they close, it moves to Europe, and then Europe opens on Monday morning, and then they trade half a day, then it moves to the States, and we open. But by the time we open, Asia's already closed, and it's already Monday night. They're going into Tuesday already. We don't even know what happened on Monday yet, right? Because the newspapers haven't told us. So then, you'd pick up the newspaper on Tuesday morning, and you read about what happened in Asia on Sunday night, Monday morning, right? So we're like a day behind. And so what is interesting about this is that during that time, as we moved from the summer into the fall, you know, the global markets were getting tired. They were getting exhausted. We had this tremendous move in the Dow. We were now trading at about 2,200 that's what that represents right now, about 2,200 at the top of the blue line, not the pink line. And global markets were coming under stress. Then we move into October, and then for anyone who was here at that time, it looks like we were all here, is that the markets going into that week, it was like the 14th, 15th, 16th of October, the markets were down. There was pressure, pressure, pressure every day. And the markets were down fairly significantly, which was new to the markets. They were down 100 points. They were down 90 points. They were down 90. They rallied back 30. They were down 50 again. And so that was something that was new. It was kind of a new tone to the market. A lot of it driven by new products. So this is part of the story. These new products that got developed, and one of them was called a portfolio insurance product. And a portfolio insurance product, and this is interesting for treasurers here, a portfolio insurance product is a product that was designed to help you, or to help the asset manager protect the portfolio. So this insurance used to, pull in all this data from around the world and market moves and technical moves and all that stuff, and it would produce a signal. You either stay neutral, you either put more money to work, or you take money off the table to protect the portfolio, right? So if the market's under pressure, they'd say, okay, raise some cash, which means you got to sell some stock just so you have cash, and then you take that cash and you wait. When the signal goes by, then you put the cash back to work. Here's the problem. That portfolio insurance was sold to every asset manager around the country. Everybody gets the same signal at the same time on the same day. So everybody gets a sell signal. Hello? What's happening, right? Now, here's the difference. Your portfolio is $100 million, and your portfolio is $1 billion. So if the insurance says you need to sell 2% of your portfolio to protect it, well, your 2% is very different from his 2%, right? Because he's got $1 billion under management, you got $100 million. So that's a different number, right? So think about that happening across the globe, because it wasn't just U.S. asset managers that bought into the product. And it was a very sophisticated product. I'm not putting the product down. What I'm saying to you, it's part of the story. And it's part of the story that people have to understand, and it goes right to, Jaime's comment about rules and regulations after the fact and what happens, right? Okay, so that happens, and on that day, we went into that Friday, and the market was down 100 points. You could feel the pressure was very heavy. Volume had exploded. I went home that night. I was exhausted after the week. But it was good. When I went home, my wife could understand it because she'd lived it. She knew it. She understood what I was going through. So it wasn't like I couldn't go home and have a conversation. I could. And I remember going home that night on the Friday and saying, it just doesn't feel right to me. I was only 26. So I'd experienced nothing. And so, but I said, it doesn't feel right to me. Well, Sunday night, you go to sleep. Now, I was 26. What did I know? Again, the news wasn't like it was today. You can go on the internet today and find out what's going on in Japan. At 9:01, you can find out if the Japanese markets are up or down and what they are. Well, you couldn't do it then, right? So I tucked myself into bed on Sunday night, get ready for waiting for Monday morning, and I get up Monday morning and I do my usual routine and get on the 5 o'clock train, get my cup of coffee, get on the train, drive to, sit in the train, go to the city, read the newspaper. But I'm catching up from Friday because Monday's paper was all about Friday. Meanwhile, what had happened overnight, Sunday night into Monday, was this global meltdown had started, and it started in Asia, naturally, because that was the first market to open. Asian markets got clocked. And then it went, as the day moved on, it went from Asia, and then it went to Europe, right? European markets got clocked early on the opening. But now listen, we're still sleeping. We're just starting to get up. I'm on the train. I get to the floor, and I would get to the floor of the New York Stock Exchange. It would be 7 o'clock in the morning. I'd get the booth open. I'd go through my work from Friday. I'd make sure there were no problems. Everything was settled. There were no televisions. There was no radio. There was no internet. The only way I ever found out, or anyone on the floor ever found out what was going on, was somebody on the outside would call you up and say, hey, listen, did you see this? No, I didn't see it because I can't see it down here. Tell me. So I'll never forget the phone rang about 7:15. Now, 7:15 is early, right? It's early for a customer to call you because the market didn't open until 9:30. 7:30, this buddy of mine who worked at First Boston, he was a customer and worked at First Boston. And he calls me up and says, hey, dude, you have any idea what's going on? I go, no. I mean, other than it's a beautiful day and I'm here at work. And what do you mean, what's going on? I'm not following you. There's a global meltdown. I go, what? So he starts to tell me, because now he's at work up at the offices of First Boston. First Boston has the access to the information, right? Because from upstairs you have the access. I didn't. So he starts explaining to me, and I'm going, oh my God, your Asian markets got clocked. Europe was just a mess, and you could feel the tension now building in the States. About 8:30 in the morning, you started to get sell orders. Every order you got, the phones rang, and every order that came down was a sell order, a sell order, a sell order, and everything was at the market. Don't sell it and try to sell it at $90. Sell it at the market. Johnson & Johnson was a $95 stock on Monday morning. It was a $45 stock on Monday night. Okay? So you understand. That's Johnson & Johnson. They make baby powder, right? So this is, but I'm trying to paint this picture for you so you understand that it was the most incredible experience because you could feel the nervousness in people's voices, right, when you picked up the phone. Because there was none of this with the customers. There was this with the brokers, but with the customers, you could just feel the nervousness. Consequently, that's what happened that day. It was just sell order upon sell order. And now understand, the portfolio insurance game. Every time the market ticked down and it broke another technical level, what happened? The portfolio insurance said, you got to sell more, right? Because now we've broken these levels. So everyone gets the same signal, and the wave starts again, right? You got more sell orders. And it was, sell 150,000 Coke, sell 100,000 IBM, sell 200,000 GE, depending on the stock and the capitalization would dictate the size of the orders, right? So that's October 1987. So now, the Fed came in, if you remember correctly, the Fed came in and they backstopped everybody. They tried to calm the markets. They tried to calm, investors, which was the right thing to do. And so they did. We struggled for another couple of weeks, you see where the pink is, and then boom, the market just took off, right? And so this was the late 80s into the 90s. Everything was good again. The economy was great. We'd gone through a number of presidents now. Bill Clinton was president. The economy was humming along. Global economy was good. Everyone was happy. Everyone was making money. And so the Dow goes from, it was at 2,200, went to 1,700, now it's back up to 10,000. And I say that, and I put that note there because we hit 10,000 actually on my birthday in March of whatever year that was, probably 96, 97. And I had been, actually that had to be 98 because you see I started a company because I was working at Salomon Brothers at the time and I was managing the New York Stock Exchange division for them. And Salomon Brothers got taken over by Smith Barney. And they took us over. So as an emerger, there's duplication of jobs and duplication. So people get eliminated and people get moved around. And so, you and I had the same job. You had it at Smith Barney. I had it at Salomon Brothers. And so you took us over. Guess what? Right? So I get that. This is the world we live in. I understand that. Smith Barney was a very different firm also. It was a very retail-oriented firm. They've got retail brokers all over the country, and they raise assets, and they give assets out to asset managers. And so they did a lot of business because asset managers would do business with them because they raised money for them. Salomon Brothers, on the other hand, was not a retail firm. It was an investment bank, and it was really, it lent itself to committing its own capital to help trades happen for institutional customers. The cultures were different. The pay scales were different. The people were different. But you brought us, you bought us. And the reason that happened was because there was this, if you remember it, there was this Russian ruble crisis, there was this Latin American debt crisis, there was this WorldCom MCI crisis where WorldCom was trying to buy MCI, and there were huge bets around the street on who was yes, no. And when the deal fell apart, a lot of big investors and investment banks lost a ton of money. Salomon was one of them because that's what we did, right? We put our money on the line, and we did. And so Warren Buffett, who owned the majority in Salomon Brothers, raised his hand and called his buddy Sandy Weil at Smith Barney and said, okay, I'm done, I'm out. I want out of the brokerage business. Come and take me out. And when Sandy Weil bought Salomon Brothers for $9 billion, which was is a lot of money, but the numbers they're throwing around today, $9 billion like pocket change, right? But so he did. And so at this moment, then, I found myself in this position where I was no longer managing that division, and I was just to fall in line and be one of your deputies, and I chose not to, right? That's not who I am, so I chose not to. So I left and I started my own company. I started my own under a company called ICAP. ICAP Corporates is a British-based interdealer broker. They worked as kind of the infrastructure, and I started a business underneath that umbrella. But it was 1998, 97 into early 98. So this was one of the turning points, because as we were coming into the late 90s, into 2000, there was a lot going on in the industry in terms of conversations about should we break the fraction, because up until now we're trading in fractions, right? An eighth, a quarter, 3/8, half, 5, 1/4, 7/8, and the next full figure. So between every price point, there's 7 prices to trade at. And there was a lot of conversation as we moved into the late 90s from the big asset managers that if we broke the fraction and went to decimals, there'd be 100 price points to trade at. They could automate a lot of the functions. They could eliminate a lot of overhead. They could save a lot of money. And so this conversation was going on, and it was right about now that it really started to heat up about really decimalizing. Because in a fractional environment with 7 price points between every full figure, when you walked into a crowd, you had to be able to understand what your customer wanted to do, what the crowd was doing, how aggressive you wanted to be or not be, how aggressive were the other people in the crowd. Every tick was 12.5 cents, so if you paid from an eighth to a quarter, you paid up 12.5 cents. A quarter to 3/8, you paid up 12.5 cents, or you sold it down, right? A computer couldn't do that because the fractional environment, the tick was too big. Between an eighth and a quarter, it was too big. The computer couldn't process, and it was very much, you had the sense when you walked in the crowd. So this is why it worked, and it worked so efficiently. As we broke the fraction, and we started to do that in 99. They went from eighths to 16ths. It's a little bit confusing. And then we went to decimals. So now there's 100 price points to trade. A penny, 2 pennies, 3 pennies, 4 pennies, 5 pennies. Now gives rise and birth to automation. You've got quant guys who are not even business, they're not finance guys, whatever. They went to college, or engineers, or computer guys, they're quant guys, quantitative guys, who can write computer programs. And if you remember, like we do when we were in high school, like the flow charts, right? If A, then B, if B, then C, that kind of thing, right? Except these are much more sophisticated. And I laugh when I think about those flow charts, but so this is what started to happen, and this was driven by asset managers. It wasn't driven by the institution, it wasn't driven by the investors, it wasn't driven by the retail investor. It was driven by the big asset managers, CalPERS, Fidelity, Vanguard, because they wanted, if they decimalized, they could automate and they could eliminate. So the push down in Washington came from them. They hired a lot of lobbyists, they spent a lot of money in DC. Do I need to tell you? And so we went to decimals. And so that was really the first turning point. The next turning point was, if you remember, or what happened at that point was the Nasdaq market. If you remember, the dot-com bubble was 99, 2000. Anything that had a .com next to it was just explosive on any day. If you didn't get in on the opening, you missed it. Stocks were priced at $30. They opened at 300, traded to 700, and back to 400. And you're sitting there scratching and go, what am I missing in this picture? These investment banks say this company's worth $30. Why is someone paying $500 for it? Makes no sense. But it was like, what was that craze in Holland? The tulip bulbs, right? I guess back in the 1800s, right? People just got nuts, right? It's like this herd mentality. That was happening in 98, 99, 2000, and then it all crashed, right? We had that dot-com bubble crash. The Nasdaq market led this crash. The market then comes under pressure. And you start to see the beginning of another kind of correction, and then 9/11 happens. And now 9/11 was a seminal event certainly in this country, but it was certainly a seminal event in the industry. Because up until this point, the New York Stock Exchange was the marketplace. The Nasdaq was the marketplace for smaller stocks. The New York Stock Exchange was the marketplace for big blue chip Americana type names, right? There was one location. Anybody that wanted to buy and sell Coca-Cola or GE or Johnson & Johnson ultimately ended up at the New York Stock Exchange. However they got there, however their broker got them there, they ended up there. And so when I walked into a crowd, I could say to the specialist, what's going on in Coke? And he would give me, he would give me the market, the buyer, the seller, the size of the bid, the size of the offer, who the players were. And so then I could start to assess what I was going to do, how I was going to represent my customer. But because everyone had to come to one spot, everybody had the same view. Nothing was hidden. Everybody had access to the same information, which is what created the efficiency at any moment in time, right? You say, okay, but the stock's trading at $50 at 10 o'clock. Why is it trading at $51 at 10:30? Well, because either news came out or you had a couple of aggressive buyers that came in and took the stock up. It's like anything, right? Supply and demand. Except, unlike, like the real estate market, right? The value of the house is what it is. Stocks just move faster, right? And that's how it works. So now, 9/11 happened. And the trade centers, which were only 3 blocks away, when they came down straight, right? Versus falling down across Manhattan and potentially creating all this other collateral damage. They didn't do that. And so, but it was after this event that, let me just see what the next slide is. Okay. It was after this event that the industry got together again and said, okay, how do we fix this? Because now it was clear to us that the New York Stock Exchange was in fact very much a target, right? And if they had knocked the New York Stock Exchange out of commission, they would have brought this country to its knees. Why? Because people in this country and around the world come to the New York Stock Exchange to raise money, to invest money, to put money to work. If the exchange didn't open and there was no trading, people couldn't do that. And to his point, we were closed for a week. And to Jaime's point, when he made it, when we opened up on September 17th, 2001, that day the market also was down 700 points. It was down 700 points on fear and panic and people who wanted their money. After what just happened, no one knew what was going to happen and people wanted their money. So what did they do? They sold stock. But because there was a week that we were closed, people couldn't do it. They were almost panicking, right? Because they couldn't get their money. It was like you went to the bank and there's no money. And so that event, just from a trading perspective, I will tell you, was on that Monday was probably one of the most dramatic days of my whole career down there at the floor. But I will tell you, at the end of the day, even though the market was down 700 points and there was a lot of pressure and there was a lot of sadness because there were a number of people who we lost, it was probably one of my most proudest days as an American because at the end of the day, the system worked. And we functioned, and people were able to invest their money or not, either put it in or take it out, did what they wanted, and at 4 o'clock, when the bell rang and it was over, we knew that we had made it through that event, as difficult as it was, and that we as a country would move on in terms of our financial system, because the financial system is really the basis of everything, right, when we talk about the U.S. capital markets. Okay, so that now becomes, at the bottom there, you see where the skull and bones is the bottom of after that event, right, after 9/11. And then once again, there was the government got involved, the Fed got involved, tried to calm everybody down, everything was good again. And so then you see the market kind of churns for a little bit, and then it moves higher as we move into, 2000 and, what's that say up there? That's where the peak of my career, and both my daughters go to college, right? Money drain, and yeah, I get to pay for tuition right at the top. And so now this takes us right to, 2007, right? That's where we are at the moment. And so this red line here is the crash from 2007 to 2009 was the financial crisis, and it represents probably almost a 60% pullback from the high, right? But that happened, it was dramatic, and I could talk about that all day, the year and a half, if you really want to sit and talk about it. It was, again, a very exciting time in my life. It was very tense, certainly caused a lot of angst amongst a lot of people, but that's kind of what it looked like, right? And so what do? Really, you gotta hang tight, right? You can't panic. You gotta put it all in perspective and try to move on. Okay, so now, after that, March of 2009, the Fed came out, Ben Bernanke, QE1, which I think was actually very appropriate at the time. And that, you see right where the blue line starts, and then boom, the market took off because people once again felt that the Fed was there. They were going to protect it. They were going to protect the system. They were going to protect investors. We were mending, although slowly but surely we were mending, and so this takes us to where we are today, right? And so at about, I don't know, 2010-ish, I was frustrated with what was going on in the industry. I was frustrated with the technology and the electronics that had taken place. And so I started being more vocal. I'm vocal like this because I go out and speak around, but I'm also vocal because I write a daily newsletter, which really speaks to you. It's not a Wall Street. It's not a typical Wall Street newsletter. It's like a conversation. I kind of tell you what's going on around the world, why it's important, why it's not important, why you should matter, why it shouldn't matter, why you should be concerned about it or not. I send it out every morning, but I just started writing it, and for me, it's almost therapeutic, right? So now, that's kind of the history, right? And so but I'll just tell you one other thing I'll walk you through so you understand it. It was in 2000, right after 9/11, when that whole conversation about protecting the country and protecting the capital markets in this country, how do we do that? Well, you do that through technology, right? You do that because if you create other venues, then you protect the place. So today, so then what happened was there's all these conversations, and so you'll hear things like dark pools, high-frequency trading, alternative venues. These are all things that you probably hear about or read about in the paper, and you say, okay, what is that stuff? Okay, well, I'll tell you what it is. The New York Stock Exchange was the physical place, right? And it is still a physical place you can come to and buy and sell stocks. The response to 9/11 was to create a virtual marketplace that's connected. It's like a network. It's connected by computers, and so therefore you can't really destroy it, right? They could still fly a plane into the New York Stock Exchange today and destroy the place. Absolutely they could. It will no longer bring the country to its knees because although we may be closed for a day or two, as a result, the capital markets in this country will be up and running again because of this vast computer network that now exists. And so when you think about what's a dark pool, well, a dark pool is a marketplace that's run by all the different investment banks. Everyone's got their own. Goldman's got it, First Boston's got it, Morgan Stanley's got it. A lot of the regionals have it. And what they do is they internalize their order flow, right? So instead of exposing it to the public markets, this is where I have a problem with it and where we should, as investors, have a problem with it. But what happens is if you're Goldman Sachs does business with everybody. So Goldman Sachs might have one guy that wants to buy Boeing, and he might have two guys that want to sell Boeing. Prior to today, they would have to send the buy order and the sell orders down to the floor of the New York Stock Exchange. It would have to come to a broker. The broker would have to go into the crowd where Boeing traded. They'd have to see what was going on, who else was interested in buying or selling, and then you would trade the stock, but everyone had a fair shot because everyone saw what was there. A dark pool is different. Goldman Sachs no longer has to bring that order flow to the exposed marketplace. They say, okay, we got this guy that wants to buy it. We got these two guys that want to sell it. We'll just trade it internally so none of you or me get to see that flow. See, that's where I think it breaks down. Because for Goldman, it's great. Because they say, okay, we got the buyer, we got two sellers, we're going to trade them over here, we'll print it to the tape, we charge this guy a commission, charge these two a commission, thank you very much, we're out of here. Okay, that's all well and good, except it's not good for the structure of the market. And nor is it good for investor confidence, which is another issue we're suffering at the moment. There's a lot of issues why we're in investor confidence. Part of it is because of the crisis, but part of it is also because people don't understand anymore how the markets function. And this is why it's very important that certainly people like you have a better understanding. So these dark pools that now, after 9/11, they all went down to Washington. They marched right down there, get their lobbyists. We want to be able to do this. Okay, the SEC says, oh, it sounds like a good idea to me. So now they all have their own individual dark pools. They don't even talk to each other, right? So, but here's the deal. What the SEC did do was they instituted this rule called Reg NMS, and it took effect in 2005-06. And what it does is it forces price to come to the best available price at any given moment. So wherever you're trading it, it's not like Coke can be trading at $50 on the New York Stock Exchange and you can be trading it at $48 in a dark pool. You can't do that. That's illegal. The system actually won't let you do that. You try to do it, the system will block you. So it's got to be within the framework of the market. Now remember, the New York Stock Exchange continues to be the primary marketplace. So we set the price, right? We set it in terms of what the market is. It's 50 bid offered at a nickel. So anywhere within that framework, people can trade stock away in these dark pools without violating any rules. But yet, think about it. If I'm there in a transparent marketplace and I'm trying to buy or sell something, and I'm bidding 50, but I could pay a nickel if I saw somebody offering it, or 2 cents or 3 cents if you offered it. If I never see it, I never get the opportunity. So my customer's disadvantaged, am I right? Because if they're trading it at 50 and 3 cents in their dark pool and I never see it, how can I represent my customer? I can't. Problem number one, because of technology. And this is kind of where we are today. And this conversation is actually happening in Washington right now because people are, the SEC, Mary Shapiro in her infinite wisdom now says, maybe not such a good idea. And that is a result of a lot of these recent technology failures that we've had, whether it be Facebook, whether it be bats, whether it just be out-of-control algorithms. A lot of that has caused kind of this introspection and this relook back at how the markets function. So that's, and then the other thing that happens as a result of technology, and these quant guys, besides the dark pools, are high-frequency trading. Now, you've heard about it, whether you know what it is. I'll tell you what it is. It's these super fast computers that now scan the markets because, you see, the New York Stock Exchange is not the only marketplace anymore, right? There's a dozen dark pools. There are 20 alternative trading venues, which are just electronic venues. They're not physical places. And so customers now, when they want to buy or sell something, in order to fairly represent themselves, they kind of have to be spread across all these different venues, right? Because like I said, if I'm down in the floor of New York and I'm bidding 50 and I'm trying to buy stock, but yet it's trading at 3 cents or 4 cents somewhere else and I don't see it, I'm not doing my customer a service. So the customer has to protect themselves. How does he do that? Electronically, he, or through me, can access these other venues and represent yourself and kind of be hanging out there to try to see if you get any action, right? The difference is they are dark. They are not transparent. You can't have a conversation with anybody. It's like you're blind and you're going in and you're touching and feeling. Because in New York, I can look at him in the face and I can have a conversation and I can say to him, I'll pay 50 for stock, and he might say I'm a seller at a nickel, and I might say I'll pay you 3 cents for 100,000. We just had this conversation, and he might say to me, sold. Now 100,000 just trades at 3 cents. You can't do that in a computer world, in a dark pool. It doesn't happen. So what there is missing is there's missing this information, but the information that's missing is the information for the investor. Because ultimately the end user doesn't get that information anymore from me. Before I used to provide that to him. Now it's difficult because it's fragmented. So the high-frequency traders take advantage of this fragmentation. They love the fact that the market's fragmented because there are these super high-speed computers. And again, you know, that's all these algorithms written by these quant guys, and all they do is they scan the markets like this, but they do it faster than you can blink your eye. That's how it happens. And what they do is they go looking for these small discrepancies, right? I can buy it here at a penny, and if I can sell it at 2 cents in a split second, I'll be happy to do that. And you say, okay, but it's only a penny. Yeah, it's only a penny. It's a $13 billion industry. Okay, it's only a penny, but it's worth, as of the last count, it's a $13 billion with a B dollar industry. That high frequency trading stuff, and I view that as noise because it's not real. They're not investors. They're people that are playing the game and looking for the discrepancy. They're not the long-term investor. They're not someone who's trying to put money away for their retirement, for their kids' education, to buy a house. They're not doing that. They're sitting there all day long and they're just gaming the system. Now, I have this argument all day long. They tell you, no, we provide liquidity, we do this, we do that, we're great for the marketplace. You are not. I go in to try to buy 100,000 shares of Boeing. What are you offering me? Nothing. You provide no liquidity to me. But yet he wants to know what I have to buy so he can run in front of me. Geez, this guy's got 100,000 to buy. So this guy, through the computer, is going to buy all this stock, and then he's going to turn around and try to offer it to me up here, thinking I'm going to be an idiot and buy it up there, right? And so this is part of the problem. But you see, this is where technology has gone way to the other side, and this is where, like, the pendulum swings too far to the left or too far to the right every time, and so now it's a matter of bringing the pendulum back to the middle. I'm not saying that technology is bad. Technology has created massive efficiencies. I get it. But in terms of investors and investor confidence, technology has not done anything to help the investor confidence. Anyway. We can talk. Listen, I'm happy to talk about it. Raise your hand if you want to talk about it more. Otherwise, I'm just going to move on. We get time at the end anyway to talk about it. Okay, so this was, remember I told you I started that business? So 1998. So this was the view from my office. And even though I still worked on the floor, I had an office space. And so this was the view from my office, and that was the view from the floor, from the street, right? Now these are the towers. This is the North Tower. That's the South Tower. The North Tower, as you remember, got hit way, coming this way up top, like the 100th floor, 89th floor, something like that. The second tower, Hudson River's on this side. The second tower got hit smack in the middle, which was right about here. And it took out 20 floors because it went diagonal. My office was on that side of the building, looking out over the Hudson River. And I was on the 55th floor. Happens to me every time. But we can come back. So we're going to come back to that because we're going to talk about it at the end. But that's what it looked like, right? And so then the days after 9/11, the exchange under Dick Rassler's leadership, went out and got this massive flag and hung it there, and it hangs out there on a daily basis because it was really just a symbol of the strength of the country, a symbol of the strength of the system, strength of the people, who not only worked there, but people who believed in it, right? The investors and whatever. Okay, so let's run down about where we are today, the platforms, the plays, and so that I can highlight it again and you can see this. Who's trading and where are they trading? This is really key to where we are today versus where we were. Okay, so the players, who are the customers? Well, you got the retail customer, which is us as individuals. You've got professional traders, and you see there's a subset of professional traders. Now, hedge funds, yes, they're professional traders, but hedge funds can also be under the asset manager tab. You have proprietary trading desks, which, as a result of the Volcker rule and Dodd-Frank, are going away at the big investment banks, but yet now you have them popping up as individual businesses, people who are leaving Goldman, in a group, and they start their own prop trading firm. Okay, so that's what a proprietary, and they're trading their own money. They're not trading for investors, they're just trading. And then you have high-frequency traders, which is the group I just told you about, right? These when you walk into a high-frequency trading room, it's quiet. Nobody talks because the computers just hum. That's all it is. It would be like, listen, I'm going to stop talking. That's what it sounds like when you go into a high-frequency trading room because nobody talks. They don't have to. The computers are doing all the work. Okay, so now, then you have asset managers, which is the third leg, right? The asset manager would be a mutual fund, could be a pension plan, could be a hedge fund that's managing assets. It's not a high-frequency trading hedge fund, but it is legitimately, it's got a strategy, whatever it is, long, short, risk arb, whatever it is. It could be an asset manager, right? Anyone that's managing money on behalf of individuals. Okay, so the trading community. Who's the trading communities? Well, you got the brokers. The brokers would be someone like me. The broker-dealers is where I'm working, right? The broker-dealer would be like Goldman or Morgan or a regional broker-dealer. You've got the market makers, which are well, who are the market makers? The market makers are the people now like on the floor of the New York Stock Exchange, what some of you may remember as the specialist. The specialists no longer exist because the rules changed. So therefore, they're now called market makers. They are a competitor. They don't have the same access to the information that they used to have when they were a specialist, but then they were also handcuffed at that time too. They couldn't nearly do what they can do today. Today they just become a competitor, so they don't have access to all that information, so therefore they're supposed to, that was supposed to add liquidity to the system according to legislators and the SEC and people who don't do this for a living every day decided that that's what it should do. And then there's the trading venues, and that's really important where we are today because the trading venues is really what dictates the frustration across a number of levels for a number of people, investors, retail, institutional, the government, legislators, the industry, because the trading venues is what causes the fragmentation. Okay, so what used to be one exchange, the New York Stock Exchange and the Nasdaq. So there were two exchanges, but yet they traded different stocks, right? New York Stock Exchange traded the big blue chip Americana names. Nasdaq traded, Nasdaq was born in the 1970s, and Nasdaq was really born because startup companies needed a place to raise capital, right? That's why it came into existence. And so when you got companies that didn't qualify to list on the New York Stock Exchange because they were brand new, they would go to the Nasdaq market and they would try to raise capital. And so therefore the Nasdaq market was always considered a market that had more risk because they were untried companies, they were new companies, they didn't have a history, they weren't GE and Johnson & Johnson and Coca-Cola. They were, at the time, Microsoft was a Nasdaq company, right? When Bill Gates started Microsoft back in 1982 in his father's garage, and he ran through his friends and family money, and he needed to raise more cash, how did he do it? He went to the investment banks who took his company to Nasdaq because it had no history. He went around the country selling the story to asset managers, saying, listen, here it is. It's an opportunity. Here's what this guy's invented. Here's how it's going to change the industry, blah, 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 like they do. They call it a road show when they go around the country to big asset managers looking to raise cash. And then when they get it all done, they've made their road show, they get all the money they want, then the stock goes public. It goes trade on either New York or Nasdaq, depending on which market it qualifies for. And then it begins trading, right? So you see, like in Facebook, the most recent example, and I can say it because unless you've been living under a rock, you've heard about Facebook, right? So Facebook was a private company up until May. And, you know, all the hype, and it's changed the world, it's done all that stuff. Yeah, I get it. But then they went to raise money because all the money that Zuckerberg had raised from big, you know, from asset managers, from venture capital funds, from angel investors. An angel investor, if you know what an angel investor is, an angel investor could be an individual, it could be a company, right? Somebody who's a multi-millionaire who now wants to take some money and become an angel investor. And what he does is he or she will pluck their money down and, you know, like the Shark Tank. Have you seen the Shark Tank on television? Okay, so it's like those four people, right? They're very wealthy and they look at these different opportunities, they pluck money down. Or you could be a venture capital firm, which is different from an angel investor, because an angel investor is typically an individual, but a venture capital firm is a firm. And so they raise, they'll look at different opportunities and they decide either they're going to put money into it or they're not going to put money into it. This is after most startups go through the friends and family routine, right? So now at Facebook, you had a lot of these investors, Goldman Sachs, you had that guy from Russia, you had a lot of other people who put their money in who now want their money out. Okay, it's been in there for 3 or 4 years. I want a return on my investment, right? I've given you $50 million. I want my money back. So they put pressure on Zuckerberg to say, you got to go public. Because that's the only way they're going to get their money back is if they sell stock and then they can get their money back. So then we go through that whole scene about, you know, Facebook and the road show, and he goes around the country, and you had to get in, and oh my God, if you didn't get on on day one, you were going to miss the opportunity of a lifetime, and you're going to be an instant millionaire, and look, blah, 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 blah. Right? You all know the story. And I'm sitting there really scratching my head because I am not a Facebook user. I don't know if anyone here is a big Facebook user. I am not a Facebook user. Maybe it's my age. I don't know. But the last thing I need is for everybody to know every last thing about me. The people who I want to know. Why does someone on the other side of the world have to know anything about me? I don't know, but one way or the other, I guess if you're 20 years old, it's important. But see, this is the problem. When these 20-year-olds become 40-year-olds, a lot of this stuff that they put out there is going to come back and haunt them. And they don't get it. But I do, right? And so, but you know what? When I say that, people say to me, yeah, but the world will be different then because it'll happen to everybody, so it'll just be an accepted norm. No, I don't think so. They put stuff on Facebook they would never say to each other. Who they're sleeping with, who they're not sleeping with, what they drank last night, did they do drugs, they didn't do drugs. Why would you memorialize it on the internet? It's unbelievable to me, but this is what's going to happen, right? In 10 years from now, when one of these kids who's, you know, all of a sudden moving up the ranks is going to become, you know, CEO at Citibank, and they're going to pull out his Facebook account. I don't know. Maybe it's me. Maybe I'm too old. I don't get it. But one way or the other, I'm not a big Facebook user. I'm not a user. And so this whole hype about Facebook, and you had to jump in, and I'm just scratching my head going, I don't get it. Now, I was not an angel investor, nor was I a venture capital investor in Facebook. I've got zero skin in the game, right? But I'm watching as this is developing, and they're selling this story around the country and around the world to big asset managers, and every night on the news, and they're trying to get the retail investor to call up your retail broker. You got to put in, because this is going to be, you know, this is the gold rush of 2012. And so there's this thing called greed. And, you know, they had originally this thing priced between $25 and $35, and they kept pushing it, you know, trying to create the hype. And then they changed the price from $30 to $38, and they kept pushing it. And then there was talk everywhere. The whisper number was it was going to be higher than $40. There was so much demand. Oh my God. Okay, let me explain something to you. Okay, can I just say this? They brought, I think on the day that it opened, 300 million shares to the market. Think about that number, 300 million shares. When a stock, you know, they compared it to LinkedIn. If you, okay, now LinkedIn I am a user because I actually think LinkedIn is probably a good tool, right? But when LinkedIn came, it priced at $42. They brought 7 million shares to the market. See the difference there? 7 million shares, 300 million shares. It's all about supply and demand, right? So when LinkedIn opened, it was priced at 42 on Tuesday night. It opens on Wednesday morning. There was, in fact, all this built-up demand because there wasn't so much for sale pre-market. And there was much more demand for it, right? So people who couldn't get enough of it because they wanted LinkedIn. But because the company said, we're only bringing 7 million shares to the market, that's all we're bringing. So what naturally happens? Well, when the stock comes to be traded, that Wednesday morning, it comes to the New York Stock Exchange, there's this big fanfare, the CEO comes down, they ring the bell, all this hoopla. There's this pent-up demand from investors. And so the stock opened at $78, which was almost up 100% from where they priced it, which, by the way, is another stupid thing, and I'll explain that to you in a minute. It proceeded to trade up to 108, and then it closed down, I think, that day at about $89, something like that. But on a certain level, that made perfect sense because there was only 7 million shares that they brought to the market, and there was, in fact, all this demand. Now, what I'll say is wrong about that is that the investment banks that brought this deal, think about this for a minute. It's your company. You're selling stock in this company. The investment bankers say to you, we think it's worth $42 a share. Okay, you don't know. You trust them. You sell your stock at $42 a share on Tuesday night to all these people that want to buy it, and on Wednesday morning it opens at 80. And you're sitting there scratching your head and you're going, but you told me it was only worth 42. Why is it trading at 80 less than 24 hours later? See that? Now, that's because I would say in that case, the investment bankers misjudged the market. They misjudged supply and demand. They misjudged how aggressive investors were going to be. That's what caused that pop. But the other thing that caused the pop was there was only 7 million shares that they brought to the market. So there wasn't a lot. So there was this run, right? People were just buying at any price. Okay, but the banker just told you it's worth $42. Why are you paying 60? But because he was going to pay 65 and he wanted to pay 70 and he wanted to pay 90, it's like anything, right? It's almost like the real estate market prior to the crash, right? Every year it went up 20%. When do houses go up 20% a year every year? I mean, think about it. But anyway, in Facebook, they brought 300 million shares to the market. And they brought it at $38 a share, which was at the high end of the pricing range. And they still told everybody that it was going to 100. You had to get in. Well, guess what? First of all, it did not come to the New York Stock Exchange. Let's just get that on the table. It went to Nasdaq, that automated venue, okay? There was nobody like me to stand in the middle and say, wait, full stop. Because that's what we can do at the New York Stock Exchange because there's still humans there, right? When something is out of control or something doesn't feel right, we get to say stop. But in an electronic environment, you can't do that. There's nobody to say stop, which is why you see what happens in the electronic world happen. Because they're computers that run wild and they run out of control and nobody's there to say stop, which is part of the conversation going on right now in Washington. Anyway, so they bring Facebook to the market, 300 million shares, thinking that, you know, this thing is, you had to get in, and had to get in, had to get in. And so everyone knows what happened. The thing opens at $42 and proceeds to go, right? Lost 50% of its value very quickly and still is trading down 50% from where it opened. It's probably trading down 40% from where they priced it. But again, you see, I will tell you that the investment banker made a huge mistake. They hyped it, they hyped it, they hyped it. They tried to create this worldwide panic in Facebook. And then they brought way too much to the market. But not only did they bring too much to the market, but then it was clear that in 90 days there was going to come another 100 million coming to the market. Hello? What are you thinking? So Facebook goes to where it goes to, right? Well, it traded as low as $18, I think, during the summer, or 19 bucks. I think it's trading at 21, 22 balls. And it hasn't really recovered at all. And now, you know, as you go along, you see they run into the same problems that a lot of other companies are running into, whether it's you know, revenue creation, job growth, whatever it is, right? So they're running into these problems. So the point is the market will dictate and the market will price the risk. And it always does. Sometimes, you know, it gets out of sync, but then the market comes right back. Okay, so where are we? Okay, so now what you have is, as a result of 9/11, and after that event, I said you started to get this creation of these alternative venues. So the New York Stock Exchange now actually has 3 exchanges. It's the New York, it's ARCA, which is an electronic platform, and it's the Amex, which was the American Stock Exchange, which they bought after 9/11. Nasdaq now has 3. Nasdaq is a completely electronic market, and all their 3 marketplaces are electronic. BATS was a new venue. It's a new exchange that came into being. It was born 2004, 2005, as was Direct Edge. Chicago and the National are 2 other exchanges. Chicago was always it was a regional exchange. It was very small, and the National Stock Exchange was also had always been there, but no one ever paid attention to it. Right? It was like the stepchild down at the end of the bar. No one really paid attention to it. But now in this new environment, it has taken on a new prominence because of these alternative venues. And then underneath, you see these 50+ alternative systems. So ECN is an electronic communication network. It's a computerized network, right? Then you have the dark pools, which is I told you about. Internalization is what the dark pools do. They internalize a order flow. They don't expose it. And then the voice brokered third-party matching, which means you still have a broker involved, but you will, the broker, if I'm a buyer and the guy working next to me at the same firm as a seller and we get it together, we can, like a dark pool, we can just match it and print it. We don't have to bring it to the exposed market anymore. And I think the biggest problem here is that it doesn't come to the exposed market anymore. And that's where we're losing investor confidence. And that's something that, you know, you should all be aware of when you're talking to the people who are managing your assets, you know, the asset managers that you give your money to. You need to make sure you understand how are they doing it, how are they representing it. Are they, in fact, are they in a transparent marketplace? Do they carry on most of their business in a dark pool? Is that the best thing for you? Because trust me, those conversations are happening and they're very real. And I'm not saying that because I'm a voice broker. What I'm saying is that because I believe in the market structure in this country, transparency is what we were built on in the markets in this country, and transparency is not what we have today. And so that is a very real concern, and it is actually especially after the couple of blow-ups over the last 6 months, whether it was Facebook, whether it was the night trading debacle. I mean, listen, August 29th, I wasn't even at work, right? I was on vacation August 29th, and we had a technology failure at 9:28. I had all these orders that had to go out, and the guy I'm working with, sent them out into the electronic system, and 15 orders, and 10 of the 15 orders made it out there, no problem, to be executed on the opening. I wanted to buy all these stocks on the opening, and 5 of the orders got stuck in the system because at 9:28 the system failed. But the system fails. My handheld failed. But yet at 9:30, the bell goes ding, 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 and the market opens immediately because that's what everybody wants. Everybody wants instant access. The bell rings, open the market electronically, and it just opens, right? I've got 5 orders that missed it because I'm stuck in the system. It cost me $1 million, right? It cost me $1 million very quickly. And I was home in my bathing suit. It was August 29th. It was the last week of the year, right? My partner calls me up and he says, you got to get to work. Why, what happened? And he tells me, and I go, oh my God. Okay, so this is the end of it, right? So I get to work, we fix the problem, but it was a technology failure, once again, because it was the technology that failed, right? And that nobody could stand up and say, wait, stop, full stop. Now, I will say this. Had I been to work that day, I would have been the one with the orders when the technology failed. I could have said full stop. But I can't go back and play Monday morning quarterback because the guy that was helping me out didn't do that. Okay, thank you very much, $1 million later, yeah, right? Hello, but, okay, so anyway, that's the makeup of the system today, right? And so the key issues are here, the hidden market. So the hidden market are those dark pools. That's what I'm telling you about the hidden market, right? Those are the ones you can't see. So it's like the elephant under the water, it's the iceberg under the water. You can't really see it. You can't have a conversation with anybody. You can't talk to the computer and have the computer tell you what's there. Unlike you go to the New York Stock Exchange, the other broker, you're going to have a conversation. Because that was the point, to be able to have a conversation. It didn't also mean that when you walked into a crowd and had a conversation with me, that I took my order and I just exposed it like this and I told everybody what I had. It's not the way it worked at all. I would come in and I would assess what you wanted to do. You might come in and you might say you're a buyer. Okay, I'm a seller. You might only have 1,000 shares to buy and I've got 100,000 shares for sale. I'm not going to tell you exactly what I got yet until I sense that you're real or not real. Okay, ready? It's like you're trying to sell your house. You got your house on the market for $500,000 and the real estate broker brings me in, right? Now I can pay $800,000 for the right house if I find it. But he's showing me this house for $500. He says, you should look at this house. It's a great house. I'm not going to go in there and tell you I can pay $800. You're offering it $500. I'm going to bid you $400. Am I right? I'm not going to expose myself. And so therefore, it's the same thing in the stock market. I would make my bids and offers based on a conversation I had, right? Now, even though you might be able to pay higher, I might have so much more for sale. You might be able to pay $50 for, 50,000 shares. That's great because it's trading at 49.5. Perfect. But I've got $500,000 for sale that I'd be happy to sell at 49.5. So guess what? You're going to buy your stock at 49.5. How great is that? Right? And this was the conversation we used to have as broker to broker. But this is not the conversation that happens anymore because of this. Because the computers don't talk to each other. And you can't talk to the computer to find out. All right? So this is an issue. Next is market fragmentation, right? And the fragmentation thing is what I just explained to you about all the different venues, of which there are 13 exchanges and 60 plus different venues. And so the market's fragmented. So the volume doesn't congregate in any one venue around any one price. So how do you, so why is this good? It's good if you're a high frequency guy. It's good if you've got these massive computers, because the computers are the ones that do this, scan the markets all day. I can't do it that fast. First of all, who do you call? Can't call a computer. So the fragmentation is an issue. Depends on which side of the argument you're on. Because if you're a high-frequency guy, you love the fact that the market's fragmented. But if you are a long-term investor and you're working with a broker trying to, your asset manager is working with a broker and you're trying to buy or sell something for the long term, this is not good for you because you don't have a sense of where the supply and demand is. Okay, and meet twilight. See, because they give these things names. This is a high-frequency computer, all right? And his name is Twilight, and this is what he does all day, and this is what I mean. If you go into this trading room, and there might be 50 guys with these computer screens, and this is what it sounds like. Just like that. Because this computer, and you see these are just, this tells you as it's looking, depending on the stock this guy might be looking at. This tells you where it's trading, the prices it's trading, where most of the volume is trading, and it tells you. It doesn't tell you where it's trading because it can't tell you where, but it gives you a sense during the day of how that particular stock is trading, right? And the other thing is that it's like a race to zero in terms of these are not, high-frequency guys are not long-term investors. They're in it for the moment. They'll buy it at 10 o'clock and sell it at 10:01, right? They're in and out for seconds. You are long-term investors. You've got this money you're putting to work for 10, 20, 50 years. Right? So this is noise to us. It's not noise to the high frequency guys. This is music to their ears, right? But to us, it's noise because, you're looking to put money to work for 10 years out. You don't care about the noise. You just want to be able to buy, you know, 1 million shares of Coke and put it in your investment account and leave it there, right? But you want the broker to be able to have access to that information and be able to buy it and represent your interest appropriately, properly, be able to go to the right venue, have the right conversation. But this is noise, and this is why when people talk about the noise, you know, this is the noise. And so I think this is such a great picture. But so what do? You have to, as it depends again on who you are, but if you're the long-term investor, you have to really ignore the noise, the daily noise. You have to pay attention to, you know, kind of the broader trends, whether they're broader trends in this country, broader trends around the world, because you see the other thing that Twitter and Facebook and LinkedIn and everything else has done is it's made the news around the world come to us faster and faster, right? So like I said, Angela Merkel's in a meeting. She gets up, she goes out the door, and everyone tweets about it, and the market reacts. Why? She just walked out the door. What does that mean? But yet, for a high-frequency guy, it might mean a lot because here's the other thing, is that you get these computer programs. They're very sophisticated. It's unbelievable. But they scan not only the markets, but they scan the news. They scan the news, they scan Twitter, they scan Facebook, they scan anything where this computer, this logic in the computer will scan headlines. And if there's a positive word in a headline, it creates a buy order. If there's a negative word, or if there's a sense from if the computer senses it's a negative headline, creates a sell order. But it does it like this. You can't even blink your eye that fast, how fast it happens, right? But what it does is it creates them and cancels them, creates them and cancels them. And this is the other issue when they talk about, if you hear them, if you read the newspaper, you hear them talking about how they create and cancel millions of orders per second because a computer can do it that fast, right? And what it'll do is just test it, it'll offer it. If nobody takes it, it cancels. Because the guy doesn't really want to, he's not an investor, he doesn't really want to buy it or sell it, he just wants to test it, right? And if he sells it, he'll turn right around and buy it. And the other thing that's happened as a result of kind of this market fragmentation is this other new model that's been built into the system, which is another thing you should know. It's called debits and credits, right? And so different venues pay you for your order flow. Hello? But the SEC has sanctioned it. It's not illegal. It's not illegal. The SEC has sanctioned it. It's a big mistake in my opinion. Because all it tells you is flow will go to where the guy is making the most money. So if Nasdaq is giving you the biggest rebate to provide liquidity, which means you're sitting on the bid or sitting on the offer, you're providing liquidity, but BATS charges you the least to take liquidity. So if you're a buyer and you want to reach and take the offering, you want to go to the venue that's going to charge you the least to do that, right? But yet, if you're providing, you want to be on the venue that's going to pay you the most to provide. So if I'm sitting on BATS offering at $50 and you come through and you take it from me, I'm getting a rebate and you're getting charged, right? And so you can imagine that every venue's got their own pricing structure, right? So the rebates are bigger and the charges are less depending and they're not equal. So it causes another reason. It causes the markets to be fragmented because flow will go to where these high-frequency guys, because this is another way that they make money based on their rebates, right? They'll react instantly, and then they'll sit on an offer where they're going to get the biggest rebate. So they'll maybe make a penny plus get paid an extra big rebate, extra big. It might be 25 mils. 25 mils is 0.0025. But yet, what did I say? It's a $13 billion industry, right? So listen, I don't want to walk away from here like making everyone think, you know, we're in a really bad state. We're not. It's part of the evolution, and part of this evolution was driven by 9/11 because it was the need to protect the country. It was a need to protect the U.S. capital markets. It was a need to protect us as Americans and really investors around the world when they come to the States and invest their money in U.S. equities, whether they're listed equities, Nasdaq equities, right? So that's it. So that's the end of that. And so I thank you for having me. But I'll tell you about, well, first of all, should we take questions or you want me to go right into you want my story, huh? Okay, well, listen. My story, and you know what? 11 years later, and my story still, I don't know why I can't control myself, but I can't. Maybe it's my Italian heritage, I don't. So, the World Trade Center, right? 1998, I started this business, and ICAP had their offices in the Trade Center. They had offices in both towers. They had offices on the 25th and 26th floors of Tower 1, and they had offices on the 55th floor of Tower 2, and I happen to get an office on the 55th floor. Now, I have to tell you something. If you'd ever been there to the towers, they were just spectacular. If you'd ever been to the top, the windows of the world, it was, when you were up there, especially at night, and you could see all of Manhattan and New Jersey, it was really spectacular. And so my office was on the 55th floor. I would look out over the Hudson River. So this is the Hudson River, right? And so I used to listen, I'm a kid from Boston, right? I grew up in an Italian family in Boston. I'm the middle child out of 5 kids, and I moved to New York, and you know, my mother screamed and yelled at me in 1983 when I was moving to New York, and I said, "Ma, don't worry, I'll be there for a couple of years. I'll get some experience, and I'll move back." 30 years later, I'm still in New York, and 30 years later, she's still not talking to me. So there I am. I'm in the 55th floor World Trade Center, and I used to walk in that office every day, like clicking my heels, like pinching myself, singing that song, you know, if my friends could see me now, because here I was in the Trade Center going, oh my God, this kid from Boston's got this beautiful office in the Trade Center, right? And it wasn't a dramatic office. It was just an office, but yet it was dramatic in the sense that it looked out. I was right smack in the middle of that building, looked out over the Hudson River. I could see Lady Liberty down here, the George Washington Bridge over here. It was really, really, it was just cool, right? And you used to have to take 2 elevators. You have to go from the ground to 46, and you have to walk around and go from 46 to 55, or from 46 to 110, right, depending, because there were 2 banks. And it used to take, if you hit both elevators right, it would take you between 8 and 10 minutes. By the time you pressed the button, got in the elevator, went up, walked around, pressed the other button, went up again, right, got in the office. It would take 8 to 10 minutes if you hit it right. So this particular, I used to get in the office every morning at 7 o'clock. I would get up, 4 o'clock in the morning, I'd be out the door by 4:30. I'm on a 4:50 train, my cup of coffee, reading my newspaper, blah, blah, blah. By the time I got to the city, took the train, went downtown, got to it was 10 minutes to 7. And this particular day, it was a spectacular day. I mean, I don't have to tell you, you know, right? It was just a spectacular day. And I'm sitting there, I was by myself at the moment in the office, drinking my coffee, and I had CNBC on, and doing my usual, you know. It was the beginning of September, so I was still closing out my stuff from August, right? So I'm going over my bills and making sure I paid everything, and the money that I'm owed is coming in. And then the other guys come to work, and at the time there were 6 of us. And they had the office across the hall. Their office was interior, right? They didn't have a window. My office was the one with the window. I was the boss. And so, they did their work. And they came into my office at about 10 minutes of 8 and said to me, we're going for breakfast. And going to breakfast meant we were going to go over to the New York Stock Exchange. Up on the 7th floor was the members' luncheon club. And we would go there for breakfast once or twice a week. We'd all sit down and we'd talk about business and blah, 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 right? And I said, I can't. You guys go without me because I had all this work to do. And, you know, there was all this paperwork. And I just said, you know what? Just go without me. It's fine. I'll meet you over there. So they left at about, I don't know, 5 after 8. They got all the way down to the ground. And they walk outside. And they started walking over. And one of them stopped and said, I'm going to go back and get Kenny. He gets back in the elevator, he comes out. And I'm by myself in my office, and I'm doing my thing. And he sticks his head in the office, and he says to me, come to breakfast. And I go, I thought you left. He goes, we did. We got all the way downstairs, and we decided we want you to come with us. And I said to him, I said, listen, I got all this paperwork. And he said, don't worry about the paperwork. We'll come back at the end of the day, and we'll do the paperwork. And I swung around in the chair, and I looked out the window. It was just a beautiful day. And I thought to myself, you know what? Screw the paperwork. I'm hungry, right? So I left my suit jacket and I picked up my smock and I put it on and we walked out. And now it's like 8:21. 8:30, I'm down in the lobby. And we started walking across the street. And the Exchange is only 3 blocks away from the Trade Center. So we walked fast, you could get there, it was not a big deal, right? So we walked there and went upstairs to the 7th floor and had breakfast, and now it's 8:41, and the first plane hits the tower, but yet because of the way it hit the tower coming north to south way up high, it didn't have that, where I was sitting at the Exchange, you couldn't hear it or feel it. You didn't feel or hear the explosion, right? If you were obviously over there, you did, but where I was, we had no idea. I'm eating my breakfast, and no idea. And I come downstairs, it's 5 minutes to 9. And when I got off the elevator in the lobby, there was all this commotion in the building, right? And I thought, and you just know, right? It's commotion. It's not normal. It's just something wrong. And so I said to the guard, I go, what's going on? And he said, a plane flew into the side of the Trade Center. And your first reaction is that it was like a small plane, right? Some guy had a heart attack. I mean, it happened in the Empire State Building, 1945, went right into the side of the building. Okay. I mean, not that it's okay, but he goes, I go, what do you mean a plane flew inside the Trade Center? It's not like you can't see them. They're the biggest thing in downtown Manhattan, right? It's a beautiful day outside. And commercial flights don't go down the Hudson River. It's just not part of the flight path, right? And so he goes, no. He goes, it wasn't a little plane. It was a jet. It's impossible. Jets don't go down the Hudson River. He says, go outside and look. Now, I walked out the front door of the New York Stock Exchange, which is at 11 Wall Street. Now, you couldn't see the trade centers from the front when you walk out the front door of 11 Wall. Because of the way the buildings were, you couldn't see them at all. But what I saw was this stuff in the air. Crap, just flying in the air. Paper, just stuff, smoke. And I looked up and I thought to myself, there's really something wrong here, right? But I turned around and I go back into my booth. Now remember, there's no news service there at the moment, right? So the news service that was, people were getting phone calls again. I called my wife because I figured my kids were in 9th grade and 6th grade, and it was just 9 o'clock, and they had just gotten out to school, and I'm sure she's just, doing her normal morning routine. And I'm saying, okay, she doesn't have the TV on. Let me call her up and tell her to turn the TV on and tell me what's going on. And so when I dialed the phone, she picks up and she's crying. And I don't understand why she's crying. I say, Evelyn, turn on the television. Tell me what's going on. And so at 8:45, a friend of ours who had worked in the industry, who was at work, who saw us on TV, and knew that I worked in the Trade Center, called her and said to her, where is Kenny? And she goes, what do you mean he's at work? And they said, turn on the TV. And now she's panicking because now, she goes, oh my God, what building is he in? What floor is he on? Oh my God, because you start to panic, right? And so she calls the number. She calls the office number. No, I wasn't there, right? So it rang. No one picked it up. Then she called the number at the booth down on the floor. But I wasn't there either because I was upstairs in the luncheon club having breakfast. And the guy who picked up the phone said, I haven't seen Kenny. I don't know where he is. So now, her mind is running wild because she couldn't remember if I'm on the 80th floor, on the 50th floor. No idea, right? So now when I call her and she's crying and I'm not getting it yet, I still don't have the impact yet because the second plane hasn't hit. She says to me, where are you? And I go, I'm at work. Where are you? Kind of like sarcastic, right? Because it was like a normal, I still am not getting it. And she goes, they flew a plane into the Trade Center. And I go, who's they? Who's they? And who would fly a plane into the Trade Center? What are you talking about? And as I'm having this conversation, she's watching on television, and she sees the second plane start to come around because it was live, right? You saw it. Now, I don't see it. And all of a sudden, she starts screaming in my ear. And I'm going, what are you screaming about? What are you screaming about? And all of a sudden, because the plane came west to east, and the exchange is east of the trade centers. The plane came from the Hudson River this way, right through the middle, and because it was lower in the building, the sound of that explosion and the vibration of that explosion, I'm standing in my booth at the New York Stock Exchange, and you could feel it, and I'm on the phone. And so after that explosion, and it sounded like, the only thing that I can imagine that it must have sounded like bombs dropping in Baghdad, right? I mean, because that's what it sounded like. It was this massive explosion. And so now I say to her, what's going on? In a little bit more colorful language, right? And so she's screaming at me to get out of the building, and I'm still trying to get a grasp of what's happening. But then, it was probably a minute later, the alarms at the exchange went off now, right? Now like, not the fire alarm, but the evacuation alarm, right? Because now it was clear that there was something much bigger happening here. And so they evacuated the building. And so they came around, and everyone had to go out the east side of the building, which was, kind of walk on the Broad Street side, and then they were funneling you down Wall Street towards the East River, away from there. And so I took the 6 guys that we were with. We all walked outside of the building. We got out to Wall Street, and we started walking down Wall Street towards the East River this way. And as you moved down, you could start to see the tops of the trade centers because of the way the buildings were, right? And you saw what you saw, right? You saw what you all saw on the news, was these buildings just engulfed in flames and smoke. And I think one of the most impactful memories that I just can't even shake out of my head are you could see the people that were jumping. Now, I couldn't see that it was you or you because I was too far away, but you could see, you knew people were jumping. You just knew there were people jumping. Whether they were jumping or falling, or you could see them. And I can't for the life of me get that memory out of my head when I talk about it, because I'll just never forget it. And so then we started to walk back, and then they decided that we'd be better off inside the building. So they started to tell people to come back inside. But I decided I was already outside. I ain't going back inside. And so if something's going to happen, if I'm going to die today, I'm going to see it coming, because I'm not going to be hidden in some building where I can't see what's coming at me, right? So we didn't go back in the building. We continued to walk. So I walked down Wall Street to the East River, and then I started to walk north, because I live north of the city. I live about 50 miles north of the city. And now they shut everything, right? No subways, no trains, no bridges. Everything was shut. And so the traffic came to a standstill. And so, it was very surreal, because people were like drones, just walking down the street like this, right? Like in a movie, right? And the cabs and the cars were stuck on the street, and everyone had their windows down because it was a beautiful day, and it was like everyone had the same radio station on, and you could just hear the announcer repeating and repeating and repeating. And so you're just walking down the street, and you know what I mean when I say, I know you know what I mean, it's rhetorical. You could hear a pin drop. You could hear a pin drop, because you heard the announcer, you heard the sirens in the background, but then you heard like deafening silence. You know what I mean? Can you put, right? And so I remember just walking down the street, and I, like almost in a daze, right? Now listen, I'm not hurt, but yet you're in this daze, right? So we got to Chinatown, which is the Brooklyn Bridge, and the Manhattan Bridge is Chinatown, right? And so when we got to Chinatown, as we're approaching, all of a sudden there was this rumbling again. And it felt like they were blowing up the subways, like you could almost see the streets starting to explode, right? But then it moved to overhead, and then it sounded like there was something above you that was exploding. And we turned around and we looked downtown, and that was the building that was collapsing, right? The first building, which was actually my building, because it got hit lower, so it was weakened first because there was still so much weight above it versus the other building was way up here, right? And so the building I was in collapsed first. Now what I found out afterwards was other people on the 55th floor of that building, because there were other offices on that floor, not just I can, right? they had managed to get out of the building with about 5 minutes before the building collapsed, because I knew some of them and I saw them. And I think to myself, where I would have been, because when the first plane hit, everybody in the second tower, they made the announcement to evacuate the second tower, right? If you remember the story. And then they said to everyone, no, we're okay, you can go back up to your offices, no need to evacuate. It was a whatever. But there were people that were in the stairwell because you couldn't use the elevators, right? So they had started to exit through the stairwells. And so some people did, in fact, go back up. Others decided they weren't going to go back up. And so they were on the 25th floor in the stairwell when the building got hit, right? And so they were knocked off the stairwell, and then the building didn't collapse right away, right? So they had time to get out. So they made it out with about 5 minutes to spare. Now, I think to myself, and this is why it becomes, this is why there's a reason I'm here today, I got to tell you. I think to myself where I would have been. And I would have been in the stairwell, I'm sure. I might have been helping somebody, I might have not. I don't know where I would have been. I don't know if I would have made it out, right? And I think to myself, why? Because there were plenty of other people who died that day. And by rights, I probably should have been one of them, because I told these guys to leave me, and they left me, and I was there by myself. And for some reason, he came back to get me. For no other reason than I was the boss and they really wanted me to be to breakfast, right? But had he not come back, I think to myself where I would have been. And I played that tape in my head over and over. And I had, I have 2 girls, and they were 6th grade and 9th grade at the time. And it's almost like I'm trying to figure it out, right? Like, why? Why did he save me, but he didn't save you that day? And you can't explain it. It's unexplainable. And people would say to me for days and weeks afterwards, God has a plan. God has a plan, and I believe in that. I do believe in that. And I wonder what the plan is, because at the time I couldn't figure it out, And I'm not sure I've figured it out, but it's interesting because I'm at this transition in my life right now. Right now, today, and I end up coming here for this speech, and I listen to Jorge get up here and play his music, and God is in this room, and I listen to him speak, and I'm sitting in the back, and I'm, because I knew we were going to talk about this today, and I'm thinking about this event in my mind and how it shaped me. And I'm thinking, there's a reason I'm here today. I don't really know what it is yet, but there's a reason that I'm here, and I was exposed to this, and so maybe it becomes clearer. I don't know at some point as we move along, but because I'm not a religious person. I'm Roman Catholic. Does that tell you enough, right? I'm sorry, I shouldn't have said that. I am so going to get struck down for that. Anyway, yeah, no, I hear you. Trust me. Anyway, so that's my story. That's the story. And to this day, it's so funny because I can't talk about it without getting so emotional. And you think, it's 11 years later, but I went to Italy a year and a half ago for our anniversary, me and my wife, and we were there on November 1st. And November 1st, is All Saints Day, right? And in Italy and in Europe, All Saints Day is like everybody goes to the cemetery, and it's like, and so we were there for All Saints Day, and we were staying in this beautiful villa in this town called Manciano, and this woman who owned the villas said to us, she was an American woman, and she said to us, you have to go to the cemetery today. I go to the cemetery, I don't know anybody there. You know, I'm not. She goes, no, you have to go to the cemetery. It's All Saints Day. You have to go. It's like everybody in the town goes, right? So I'll never forget this. And so we went to the cemetery. Beautiful. But, right? I don't. So I walk up, and there's this woman who was probably, she had to be in her 80s, in all black, right? The way they are. And she's kneeling by this grave, sobbing. And I'm thinking to myself, oh my God, oh my God, oh my God. I look at my wife, I go, I hope one day you're going to do that for me. I mean, this woman was sobbing at the grave. And so when she walked away, I was just curious. And I went over to the grave. The guy was dead 40 years. And she's sobbing like he died yesterday, right? And I thought to myself, oh my God, she still has got so much emotion in her that 40 years later, she's sobbing at her husband's grave, right? And I thought, and it's funny because you say, you know, time heals all wounds. And so at some point, I suppose I will get to the point where I can talk about it without getting so emotional. 11 years later, I still cannot control my emotions when I talk about it. And even more so today, because I'm here, and he left, I guess, right? Did he leave? Oh, that's too bad, because I really want to talk to him. But it was just spectacular what he did this morning. And, you know, when he said that, you know, he expects the trumpets to play and the music to blare and all that stuff, when God comes back, I'm thinking to myself, dude, he's here right now. It's your music. I mean, it's unbelievable to me. I mean, am I right or am I wrong? And so, anyway, that's it. But, so, listen, I'm happy to answer some questions. Listen, I hope it wasn't boring for you at any point, because some of it was kind of, but, you know, I think that what's important is that people have to understand what the U.S. Capitol, because you know what, it affects every one of us.
Is your friend okay? Your friend that came back to
Yes.
He's okay.
Yes, he's good, yeah, because he came back to get me, and we both left together. Yeah, he's good. Yeah, he's good, and but thank you very much. But yeah, no, he's good, and and I have to tell you, there's not a day that doesn't go by where I just don't think about him and thank him every day for coming to get me, because, you know, he actually works, right, he works on the floor of the exchange, so I see him every day anyway. But what else? Nothing? I answered everyone's questions? Yes, so, okay, so that's the deal. Anyway, you see up there is on the chart there, it tells you my morning thoughts. Now, do I have a little bit of time, or do I have to stop? Okay, so I'll just tell you really quickly about this whole morning thought, and some of you know this, but so I started writing this note, right? This daily note goes out every morning about 7:30 in the morning, and it's really a conversation, right? It's not a typical Wall Street piece of research. It doesn't speak in Wall Street jargon. It just says it the way it is, right? I tell you why you need to be concerned or not concerned, what's going on in Asia, what's going on in Europe, what's going on here in the States today, things you should look for. But it's written from kind of from a daily perspective, because my job as a broker on the floor is what's going to happen today. Because when I'm representing customers that want to buy and sell something, I have to have a sense of what's happening today, what's going to happen in the market, what's going to happen maybe in the group, what's going to happen in these stocks. But as a long-term investor, I have a very different opinion, right? So as a long-term investor, I think the market's going to be better 2, 3, 4 years from now. But from a daily point of view, the market's going up or it's going down, and this is why, and that's my perspective. So this note takes on that perspective. But I write the note the way I talk. So now that you've heard me talk, that's how I write. And I make my points with capital letters and exclamation points, and you can just hear me, right? And so it might be, I don't know, 4 or 5 paragraphs. You know, it's an easy read. And so it goes out, you know, a lot of people read it. A lot of people read it on the train. Other people read it other places. And so, well, you know, it's good reading for there too, right? But anyway, so, but what happened was I wrote this note for a couple of months. And then in like December of 2010, it was a Monday morning after a typical rainy, cold, snowy weekend in New York, you know, where you did nothing but light the fire and stay in your pajamas and cuddle on the couch and watch movies. And in my house, we cook, because I love to cook, and my wife's a good cook, right? She's Puerto Rican, so she'll cook Latin, Spanish food, and I'm Italian. I'll cook a lot of Italian food, but then we cook everything else, right? But I like to cook. For me, it's therapeutic, it's relaxing, I enjoy it. I kind of zone out when I'm cooking, right? I grew up in a family that cooked. We all cooked. I got 4 brothers and I got 3 brothers and a sister. My sister's the only one who doesn't cook, right? All the brothers cook. And so she can't even boil water, the poor thing. I mean, it's horrendous. But anyway, so I cooked that weekend, right? And so I made a bunch of different things. And so I'm there writing the note one morning in my booth at 6:30 in the morning, and the phone rings, and it's a customer who is also a friend, but he's in Dallas, Texas, and he calls me up, what's going on? We're just kibitzing about the weekend and the market. But all right, so I'm writing my note. So what'd you do over the weekend? So I told him the same thing. It was a cold, rainy, snowy weekend. I sat in the couch in my pajamas. I didn't do much. I cooked. We watched movies, blah, 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 whatever it was, right? Okay, great. Lit the fire, fine. What'd you cook? So I told him these couple of things I cooked, and one of them was simple. I made an arugula pesto dish. It's simple. You use arugula instead of basil. That's all, right? You put it over pasta. You make it the same way. It's delicious. A little bit peppery because of the arugula, but if you like pesto, you should try it, right? So just substitute the arugula for the pesto. Do the garlic and the pine nuts and the oil and a little bit of salt and the Parmigiano cheese, and that's it, right? It's simple to make. Put it in the food processor. You grind it up, put it over the hot pasta, a little bit more cheese, glass of white wine. You're done, right? Simple. So he tells me, that sounds delicious. Can you send me the recipe? I go, yeah, okay. I said, I'll type it in the bottom of the note. Because now as I'm talking to you and I'm writing this note, it's almost like I'm writing you this note, right? I go, yeah, I'll just put it in the bottom of the note and I'll send it to you. Well, I typed the note and then I put a line and I put arugula pesto. I put the thing there. I told you how to boil the pasta, cook the pasta, put it together, serve it. And I sent it. Well, I sent it to the distribution list, right? You make those mistakes? And so at the time, the distribution list was 20 people. It was 18 men and 2 women, right? Because it only went to customers. It didn't go anywhere other than the customers, right? But I thought to myself after I hit the send button, I went, oh my God. I am so going to get my shoes broken today because people are going to call me up and just say, what's with the recipe? Okay. But anyone who knows me, right? They know I like to cook. They know, right? So a very interesting thing happened. No one called me up and gave me a hard time. They called me up and they said, what was with the recipe today? And so I spent all day explaining it was a mistake. Should have gone to one person. But the response I got back from people was, it looks good. I go, it's so easy to make. It's delicious. And see, I'm like a foodie, so I'll just start talking about it, right? So that was it. So the next day, I come to work. I'm writing my note, and I thought to myself, screw it. I'm going to put another recipe in the note. I put another recipe in the note. So thus was born now my morning note. So it comes as a morning note, and then it comes with a recipe every day, right? So every day I give you a different recipe. And I give you everything. I give you Italian food, I give you Spanish food, I give you American food, I give you steak, chicken, pork, pasta, whatever it is, right? I give you whatever you want. So now, I do that every day, right? And so it went from 20 people. All of a sudden, you take it, you like the particular recipe, so you send it to your wife. You say, honey, try this. So she looks at it, she reads the note, and then she reads the recipe, and she says to you, honey, Alex, can you send this to me every day? Because it's good for her too, because then it kind of, now she has a sense of what's going on in the markets, right from the guy on the floor. She feels like she's connected, right? So then she sends it on to 5 of her girlfriends, and next thing you know, you'll call me up saying, can you add these 10 people to the list because I don't want to send it on anymore. You just send it directly from your distribution list. I go, yeah, no problem. Today it goes out to more than 4,000 people because it's just grown like that. And it goes out every day. It gets bigger, and I know it gets bigger because now I have this website that you just go in and put your email address in, and you can sign up for it. But every time somebody does that, I get a notice that says, you got another one, you got another one, you got another one. So it just grows like this, right? And it's very funny because I get people from all over the world that sign up for this thing. Some guy yesterday from London signed up for it, and I could tell because his address ends in .uk, right? And so I laugh because I think to myself, it's just food. But you know what it is? It's the food and finance thing, because finance can be very unsettling for people, and especially people who maybe are not in it. It's not what they do. But yet the way I write it is easy to understand, right? It's not difficult. I try to break it down and make it easy, tell you why it's important, and then I feed you at the end. And so it's like the yin and the yang, right? Because food, on the other hand, can be very nourishing and comforting and nurturing. And so it's kind of like the yin and the yang between the finance and the food, right? But what's very interesting is that now people people send me recipes. Like, I'll do a recipe, and someone will write back to me and say, you know, I make almost the same thing, but I do it this way. I said, okay, so send me the recipe, and I'll use it, and I'll give you a shout out. It won't be my recipe. I'll say, you know, my friend Bill sent me this recipe, blah, 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 you should try it. But I'll always make it before I put it in just to make sure it's good, right? Because I don't want to put it because then it's not good. But I got to make you laugh. So this guy from Italy, about 6 months ago, from Luca, he gets my note. And so he writes me back. He said, I got this great risotto recipe. I said, so send it to me, and I'll put it in my note. So you can go back and find it. Anyway, it's risotto made with Amarone wine. Oh, my God. It is to die for, right? It is to die for. And so he sends me this recipe. So I make it. It is delicious. So the next week, I put it in my note. But what's very funny is, now the guy works, okay, I didn't know this, but the guy works for a bank in Italy, right? He's like a research analyst. Okay. But in the bottom of the note, when it came to the recipe part, and I said, you know, so today I got this great recipe, and I called the guy out by name, right? Luca Tagliatelle, and I wrote his name down there, and I said he lives in Lucca, Italy, and he gets my note, and he reads it every day, and he sent me this recipe, and I got to tell you, it's delicious. I made it over the weekend, and here it is, boom. And I send it out. Well, the guy got the note that day. So he reads it, and he sees his name at the bottom, and he panicked. Oh, my God, you got to take my name out of there. I can't have my name. And I go, it's food. What are you talking about? Like, it wasn't like I said, you said go out and buy Johnson & Johnson or Microsoft. We were talking about a recipe. But the guy panicked because his name appeared in it, and he worked at an investment bank, and he was going to get in trouble. I go, it's food. What are we talking about? So now I won't do that. Unless you say to me, it's okay to call me out, I won't ever put your name. I'll just say, my friend Bill or my friend Susie, whatever it is. But if you say, put my name in, I say, okay, my friend Susie McIntyre from XYZ does this, and this is how she does it, and, right? But it's very funny because some people want, you know, they don't want it at all. Don't put my name in there at all. So you know, it was very funny because this guy had such a violent reaction. So I called him, I said, Luca, okay, but it's only risotto. It's not really a big deal. I don't think you're going to get in trouble for it. And he didn't, and it was fine. But it's very funny how people react to, you know, if their name is in some story that happens as well. But anyway, so that's what I do. So you can see it there. I haven't written in a couple of weeks because we had this hurricane. I was knocked out of power for 2 weeks. We just got it back on Saturday. And as when he introduced me, I've just actually separated from ICAP, the firm that I was working for, and this is what I was talking about. I'm in this transition in my life at the moment. But I had been at ICAP for 15 years, and I just separated at the end of October because, you know, it was kind of going in a different direction. And you know what? It was just time to move. You know, it's just time to move, so it's time to move. So that's it. I'm done. I negotiated. I'm out. So I guess you could say I'm among the ranks of the unemployed at the moment. But it's very interesting. I have a lot of conversations going on because, you know, it's a funny thing that when you have a job, a lot of people that want to talk to you don't necessarily, they think, you know, you got a job, you don't want to talk, and all of a sudden they realize you don't have a job, and all of a sudden the phone's ringing off the hook saying, come and talk to me, come and talk to me. I said, okay, slow down. You know, I'll be happy to do that, but I want to take 2 days to breathe. You know what I mean? I'm 51. I haven't done this in so long. I just want to breathe. So that's what I mean, you know, and that's why, like this whole thing, there's a reason that I was here today. I don't know what it was, but this whole transition that I'm in at the moment, you know, it's a little bit unsettling, but then it's not, and you know, so whatever. Anyway, so I do that. I have this Twitter account, so if you tweet, you can follow me, and that's it. I do a fair amount of CNBC and Bloomberg television, so you know, you can see me there doing market commentary stuff, and so we'll see where it goes. Anyway.
Well, Kenneth, we have a going away prize for you.
You do.
Okay. Oh, yeah.
Thank you very much.
Let's give him a big hand. He did a great job, huh?
Thank you very much. Thank you very much.